Hello, everyone. My name is William Mucker. I'm a client executive with Camaplan, and I would like to thank you all for joining us for today's webinar, The 7 Steps to Investing in Multifamily Real Estate with Ashley Wilson, co-founder of Bar Down Investments. As a quick note, please be aware that Ashley will be answering questions at the end of the presentation. However, feel free to use the Q&A function on your screen whenever a question crosses your mind, and they will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we do have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any product. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information if you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I will be more than happy to help. And then without further ado, I'll pass the controls over to you, Ashley.
Hi, everyone. Welcome to our presentation today on the 7 benefits to investing in multifamily. Okay, we're going to get started. Can everyone see my screen? Just a thumbs up, or you should be able to see it now.
Looks good to me.
Okay, great. Okay, just another disclaimer, because our attorneys also require us to put this in all of our presentations. All of the information provided is for informational purposes only. Any financial advice given in this presentation is just for information purposes only. As I mentioned before, please consult with your financial advisor, CPA, or just within your network of well-educated, accredited, people that you consult with. Okay, to start off with, my name is Ashley Wilson. I'm the co-founder of Bar Down Investments. How's it look? I'm also a best-selling author with a book titled The Only Woman in the Room. And over the past a little over a decade, I've acquired over 120 million in real estate. I consult with other multifamily ownership groups, helping them reposition properties and get their business plan working efficiently. I specialize in both multifamily asset and construction management. My partner, Jay Scott, if you haven't heard of him, you might be living under a rock. I'm just kidding, but he is a very well-known best-selling author. He's published, I think it's 5 or 6 books now, multiple bestsellers. I think one of his books is his top 5 best-selling real estate book of all time. So obviously he is very, very knowledgeable both on residential and commercial real estate. He currently owns approximately 900 units. He's a managing partner of Bar Down, so he is my partner at Bar Down. And he has a tremendous track record in real estate. He started a few years prior to myself. Okay, so let's start with a little story. I actually didn't start off in real estate. I started in corporate America and pharmaceuticals, and I worked in clinical research and development for 3 major pharmaceutical companies: Sanofi Aventis, Wyeth, which is now Pfizer, and GlaxoSmithKline. And during my tenure in corporate America, I invested, probably like most of you, in my 401k. I just followed what everyone else was doing, and I figured that if I followed what everyone else was doing, I would be able to retire like everyone else before me had done, and live a cushy life post-career. I quickly realized, though, that that is not a strategy that works today. It does not create financial freedom, and it also creates a situation that I think you may have heard before, which is kind of the golden handcuff situation where the job is paying you a very lucrative salary, but you're stuck within that position and you're stuck on that hamster wheel and you're not building up any passive income while you're working actively in your corporate position or even if it's a small business, it doesn't matter. So I started to explore alternatives. And what I came to realize is that I like to invest in tangible assets. So with my 401k, I was investing in the stock market. And for me, that is very speculative. And what I mean by that is if the stock market, if I invest in a company within the stock market and that business folds, I'm really left with nothing. There is no residual income. There's no residual liquidity event that I could recapture my initial investment on. So I started to look at alternatives and I came across real estate. And what real estate provided to me, in my mind, is that a surety that it was an asset backed investment. So, in other words, if the asset itself carried inherent value, that limited my risk profile for my retirement strategy. So, what did I do? I started investing in real estate while having a W 2. And the other reason I liked real estate is because of the freedom that real estate can provide. I looked around at colleagues of mine that were in real estate, and I started to notice that across all different asset classes in real estate, whether it be wholesaling, flipping, commercial. So when we talk about commercial, we're talking about a whole different group of assets. So let's say it's self storage or multifamily or um, triple net or true retail, true commercial, so retail, office space. That all falls, under the bucket of commercial real estate. But I realized that all of those asset classes, one thing they all had in common is they were very, very lucrative. People could be very successful at them, and that attracted me even more. So what I did is I started flipping with my father. Why did I start flipping with my father? Well, it was a no-brainer for me. My father has a construction company. He's had his company for over 45 years. He is very well versed in historic homes, large scale rehabs. And we developed a niche actually in this flipping business. Our company was called How's It Look? And we flipped on the main line in Pennsylvania, which, if you're not from Pennsylvania, it's the suburbs of Philadelphia. And we developed a very successful high end flipping business where we targeted full gut rehabs, homes from 1890 to 1960, were our sweet spot, and very large scale projects with very lucrative returns. But there was one big problem with this business, and that problem was the tax exposure. We had tremendous tax liability in this business. And unfortunately, that was ultimately one of the reasons why I decided that flipping was no longer for me. So, to put this in terms of numbers, one year I paid over $100,000 in taxes, which is just wild to me. I look back at that and realize, some people can say, well, that was a huge mistake, but I think that was the best education lesson that I think I've ever learned because that is what has propelled me to what I do today. Ultimately, this $100,000 that I paid in taxes translated to one property that I did that year. So when I looked back that year at all the rehabs that we had done, I pinpointed a house and I said, I worked for free on that house. And that really, really made me mad. So I knew there had to be a better way. I looked around and I said, there's no way that all of these people are doing real estate by giving up one project in the process, working for free on one project. So, what I came across, which was the second benefit, to multifamily investing was I looked at the US tax system. So I have learned throughout my life, I don't know if you feel the same way, but typically when you see someone's weakness, that's also their strength, but you just have to look at it from a different angle. And I realized that the tax on flipping on real estate was a huge hole. It was a huge weakness, but there had to be a strength within the tax system. And that's what I spent my time figuring out was how do I leverage the US tax system to really help me be profitable in this business where I don't give up one of my projects. Let me remind you if you don't remember during the last two debates, presidential debates, there were um a lot of different hot topics, but the one major hot topic was former President Trump's refusal of showing his tax returns, and both Senator Clinton and current President Biden both argued, well, he's not willing to show his tax returns because he's not paying taxes. He's cheating the American system. And during the debate with Senator Clinton, he whispered under his breath, "That makes me smart." And this is not a political statement by any stretch of the imagination, but what he said is true. Whether you're Republican, Democrat, Independent, doesn't matter. What he said is true. And he ultimately surrounds himself with people who know how to leverage the US tax system. And what's amazing about this is that anyone can leverage the US tax system. You just have to put yourself in a position in which you can leverage the US tax system. So I will be the first one to say that I do not know the US tax system the way the people that I surround myself do know it. I am very intentional about surrounding myself with incredibly intelligent people who know the US tax system, specifically real estate. So, whether you take nothing from this presentation, the only thing I do want you to take away is the fact that you should always align yourself with someone who specializes in real estate tax code because it is the secret sauce to winning the game of life. And this is what a lot of people, not even just former President Trump was able to do, but a lot of other people have been able to do. So when I looked into this, I dove into this, I surrounded myself with people who knew this information. I figured out that the tax system actually has a lot of different shelters when you invest in real estate. Well, why is that? The reason that we have so many different tax shelters is because the US government is tasked with the responsibility to solve a tremendous amount of problems. And one of our greatest problems in the country is our housing, specifically the supply and affordability, which go hand in hand. Ultimately, the government has to decide whether they solve the problem internally, which means they raise taxes for everyone, or alternatively, they provide incentives for the wealthy to invest in this asset class. So it shoulders the problem on the wealthy as opposed to the government continuing to shoulder this problem and figure out what to do with it. So, what the US government has decided to do is to offload this problem to the wealthy by means of encouraging the wealthy to do things like 1031 exchanges, which I know is a hot topic right now in the news. And we can talk about that another time. I have very strong thoughts on that, but I don't think we have anything to worry about there. Depreciation's another way in which they encourage investors to invest. It's a way to essentially get paper losses on your investment. Opportunity zones, that's encouraging investors to invest in specific locations. And then primary resident exemptions. Ultimately, these incentives have changed the landscape of our housing situation. We may say, that we still have a lot of issues, and we do, but it could be a much more troubling issue if we didn't have all of these tax shelters. So when I looked at all of these different tax shelters for real estate investing, it was a no brainer to me to be able to go into multifamily because multifamily tapped into a lot of these different tax shelters. So that's what I did. I moved into multifamily investing because I wanted to keep more of my wealth. And one thing that I say all the time is the wealthy aren't wealthy because they make more money. The wealthy are more wealthy because they keep more of the money that they make. They then invest that money, and that money comes back with friends. So it comes back with more money. That's the difference. So, what I'm telling you today is don't hate the player, don't hate the game, but what you want to do is you want to play the game. You want to participate, and everyone can participate. So, going back to my own personal story, I knew multifamily saw my tax exposure, but how was I going to get started? To me, multifamily was just a beast in and of itself. It was so different than what I knew and was comfortable with in terms of residential real estate. I thought that there were so many different aspects of multifamily that I felt that only, one person couldn't handle. In and of itself, it's a business at the end of the day. So I was really just apprehensive of getting started. And the major issue for me is the properties were so expensive. I wasn't looking to buy a duplex. I was looking to buy 100 units or 200 units because that is a way that I could propel my financial freedom. Well, the one thing that multifamily provided for me and for other people in this process when you're purchasing multifamily is monthly cash flow. And unlike residential real estate, monthly cash flow is able to be achieved through rentals as opposed to flipping because flipping you have these surges of cash and you have this huge tax liability, but rentals you don't have the realized gain, so you don't have that tax exposure until you go to sell. And then there's obviously tax strategies there that you can defer that exposure. But monthly cash flow, what that allows you to do is it allows you to make money while holding the investment that flipping doesn't allow you to do. So essentially, you're going to take your income, you subtract your operational expenses. So this isn't inclusive of a roof replacement, but it's inclusive of, let's say, roof patching, and then you end up with your cash flow. Now, obviously, roof replacement has to come from cash flow eventually, but when you're trying to figure out um, your overall income and expenses, you should have reserves to cover major projects, but on a monthly basis, you will have what's called cash flow that's derived from income minus your expenses. There are different types of properties in multifamily. So there are things called stabilized assets, or it could also be a core plus asset. So think of a brand new construction, A class property that produces a steady cash flow. But there are also properties that have huge upsides that don't have cash flow or inconsistent cash flow, but when you reposition them, can have huge landslide profits. So everyone has a different strategy. I'm not trying to say one strategy is better than another. I think over anyone's course of life, their appetite for risk, because it's all tied to risk, returns are always tied to risk, um, varies. So you want to pick a strategy that works best for you. For me personally, I was saying to myself, how am I going to grow quick enough? How am I going to grow fast enough? Once again, this ties into what I was saying earlier about the cost of multifamily properties. How do I parlay these two components so I can realize a greater financial freedom? Well, it's all through this little thing called leverage. And most people think of leverage and they think of a lender. They think that debt provides leverage when you go to buy a house, you offset. Most people offset at least 80% of the purchase price through having a bank loan, um, but you can leverage other things. So, one of the best things in real estate investing compared to other investments, because this isn't something you see in the stock market, but one of the best things you see in real estate, specifically in multifamily, is this concept of leveraging. So, outside of debt and outside of being able to, purchase the property, you can leverage investors and partners. You can actually go into a multifamily property with zero money in because you can put sweat equity in. You can leverage human power, manpower, and that expertise or skill can be used to grow your own wealth. Well, you might be saying, well, I'm not in real estate. I don't have a skill set that I can leverage. The beauty of multifamily is it's a business. I said that a few slides back. And what I meant by that is multifamily is a business in it of itself. The real estate is just attached to it. So you need people who are good at marketing, bookkeeping, legal, asset management, leasing, sales, construction, you name it. It probably is something that is absolutely necessary for that specific property or a portfolio to be able to succeed. So this is something that I continue to use in my own business is leverage. And I try to think whether it be capital or human leverage that will get us to the next level. And this is something that you can use yourself today, put in action today on leveraging um yourself or other people to help you get to your financial freedom sooner. So we've talked about cash flow, we talked about leverage, but how do you have the potential to realize those larger gains? It's a little secret in this industry. But if you're not in this industry, I'm about to tell you the secret, and that is something called appreciation. So we know this with residential real estate, but what we think about when we think about residential real estate and appreciation is we think about the market dictating that appreciation. And that's what happens in residential real estate. But in commercial real estate, it's completely different. So let's talk about the two different ways in which a property can appreciate. So one is natural appreciation, and that's what I was just talking about with residential real estate. The second is called forced appreciation. Forced appreciation can happen one of two ways. You either increase the income or you decrease the expenses. Why am I saying that? Well, let's back up a step and let's talk about how multifamily property is evaluated. Multifamily property is evaluated in commercial properties in general by taking your income minus your operating expenses. So once again, that analogy that I gave earlier, or not analogy, that example I gave earlier with the roof patching versus roof replacement. Roof patching is an operating expense. Roof replacement is a capex expense. So we're not taking the roof replacement, we're taking the roof patching. So income minus operating expenses equals your net operating income. You're going to take your net operating income and you're going to annualize that. So not taking monthly, you're taking your annualized net operating income, and then you're dividing that by the cap rate, which is the trading rate within a given market for a specific asset class, and you get an evaluation. So when you look at this equation, what you quickly realize is that you have control over the evaluation. Well, how do you have control? Well, going back to what I said before, you can increase the income, decrease the expenses, or a combination of the two. So, increasing the income is one way that is very common in multifamily to increase the appreciation. And that is through forced increase. So, to put this in perspective, if you have two multifamily properties that are built by the same builder, they are next door to each other, same school district, same specs. So, 50% of the property is one ones that are 700 square feet, one bedroom, one bath. 50% of the property is two bedrooms, two bath, 900 square feet. And the same on the other properties, same amenities, everything. If one property is charging more in rent, that property is worth more. If one property is only has one head count for maintenance and the other property has three head count for maintenance and all other expenses are the same, the property that has less expenses is more. It doesn't matter if that property sells for $1 million. The property next door doesn't necessarily not appraise for $1 million. It could appraise for $3 million. It could appraise for $500,000. It all comes down to this approach, which is called the net operating income approach. And that is the most common way in which multifamily real estate is evaluated. Now, there are two other ways in which multifamily real estate is evaluated. One is the comparable sales approach, which is the same way residential real estate is evaluated. And then the second way is replacement value. And replacement value is typically used by insurance providers when they're insuring the property. But with respect to purchasing and for lending, they use this whole evaluation that you see on the screen here, which is the net operating income approach. So to have control over the evaluation, I mean, how many other investment strategies where you actually have control over the evaluation? Not many. So your direct effort into the property can reward handsomely. Single family, you're at the liberty of what the market's doing. Multifamily, indirectly, you are with the cap rate. We could argue that, I'm sure. But ultimately, you're able to control that numerator value, which is the annualized net operating income. So I did talk a little bit about changes in the market. Today, the hot topic over the past 6 months has been inflation, maybe even more than that. Past year has been inflation. So isn't it becoming more difficult then to own and operate when inflation plays into these variables? I mean, you can't really control all of the variables. Well, this is the sixth benefit to investing in multifamily, specifically multifamily. Multifamily has historically been known as a hedge against inflation. Why? Well, if you've also been following, and I'm not someone who follows mainstream media, so I'm not endorsing this, but if you do follow mainstream media, you would probably know more about this than I do with respect to what they're saying. I know what the source data is saying, which is the rental increase over the past year has been outstanding. If you're a landlord, if you're an owner, not so great if you're a tenant, but the appreciation, I mean, at our one property alone, we were able to do renewals anywhere from a $300 to $400 increase in 1 year. I mean, that was just insanity. So I think that when you look at the most recent data, look at historic data, it's still shoring up that multifamily rents trend with inflation. It's a hedge against inflation. Um, it also is the safest. If you look at all of the different asset classes, it is, you could argue, I'll always say that, I'll always put a caveat in there. You could argue that multifamily is one of the safest real estate asset classes throughout all market cycles. And when we look at that, we obviously want to look at a recessionary period in market cycles. So not recovery or hyperinflation. We want to look at recession market cycle. And when we look at that and we look at historic trends, the rents actually go up during recessions. So you might be saying, well, that kind of doesn't make sense. But if you dive into the details, it actually does make sense. The reason being is, look at today. It is getting more and more difficult to purchase a home. Homes are becoming more expensive because what is becoming more expensive? The debt. The debt is becoming more expensive, which forces people into renting. People who could otherwise afford a home, now they're renting. And when they rent and the supply stays consistent, then they're forced into renting. The demand goes up. We know from basic economics, Econ 101, when supply stays consistent and demand increases, then you're going to have this impact on rents, which is the rents are going up, or they even can stay stable during a recessionary period. But historically, they have gone up. So this is just another great example of multifamily's recession proof um, profile compared to other asset classes. So for me personally, I was convinced multifamily was definitely the real estate asset class that solved all my issues. I mean, it solved my tax exposure issue. It solved my ability to want to scale and grow my wealth faster by using leverage. It provided cash flow while holding the asset. It also allowed me to control the evaluation, which I loved because I just love, finding these little nuances. I'll give you a quick little story. We purchased one property and they had these gardens throughout the property. And we wanted to, when we first purchased the property, we did uh, all these inspections and found out that the water system for the gardens needed a $3,800 repair. So $3,800, that's nothing when you're buying, a $20 million property. But when you dive into the numbers and realize, okay, well, we're going to have to pay $3,800 in repairs. We have an increased water bill. We're going to have continual repairs on these gardens. We're also going to have landscape fees ongoing. Plus, we're going to have capital surges to, every quarter change out the gardens, etc. We ripped out all the gardens and we spent approximately $75,000 doing that as opposed to $3,800 repair. And you might say, that's crazy. Well, because of all of those expenses that I calculated, that actually added $680,000 in value to the property. So instead of making that $3,800 repair and having a $680,000 hit on our evaluation, we spent $75,000 and we're able to add 680,000 to the evaluation of the property. So that's what I'm talking about controlling the evaluation. And then also just looking at historic data. So the slide is just one, the previous slide was just one example of how multifamily has this very strong track record. But there's more. Multifamily has, the title of this presentation is 7 benefits. I've only given you 6. So what's the 7th benefit? The 7th benefit is the fact that you can do it passively or actively. And the reason you can do it passively or actively is because you can continue working, your 9 to 5 or whatever you do, and you can leverage, as I talked about before, you can actually leverage other people investing and you can invest alongside of them. So that's one way you can do it passively. You can also do it actively. You can either do it on a small scale, you can do it with duplex or triplex, quads, whatever, or you can buy large multifamily properties. It's shocking now that I know this, but when you drive around and you see these 100 and 200 unit properties, they're owned by people just like you and me. They're not owned by these major corporations, not all of them. Obviously, there are a lot that are owned by major corporations, but there are a lot of them that are just owned by small groups and small partnerships and friends and family. So if this is something that appeals to you, it is 100% within your reach. So that's another thing that is hugely just alluring to me is that literally the ability to grow financial freedom and build generational wealth is at your fingertips. So I want to just thank everyone now. I'll open up for questions. If you have any information our company, Bar Down Investments. You can find out more information there. You can email me at ashley@bardowninvestments.com. If you're interested in investing actively, we have a program that you can find more about. It's called Apartment Addicts, apartmentaddicts.com. We have a free 3-day crash course next week going on. You can sign up for if you're interested to learn a little bit more. But either way, I definitely think that everyone should be involved in multifamily, even if it's not 100% of your retirement portfolio, your investing portfolio. We personally not only invest in every deal we do, but we actually invest in other people's offerings as well to stay diversified, and not have exposure on just one operator, one market, or one asset class. So I would encourage you to do the same, but of course, check with your financial advisor or CPA or any other trusted advisors you have and make sure that you make a decision that fits your own personal investing style. With that, thank you very much. I appreciate it. And feel free to ask any questions, as I think we have about 5 more minutes.
Great. Thank you for the presentation, Ashley. While people are getting their questions queued up, do you want to talk about anything in particular that excites you about what you and your team at Bar Down are doing at the moment?
So we offer both single investments that we syndicate or JV on, and um, that profile is for someone who likes more of the reposition, less cash flow, but more participating in the upside. We're personally known for our focus on operations. So for years now, since I started the company in 2018, I have been a proponent that people have relied heavily on the cap rate to exit a property, which essentially means that they were waiting on um, natural appreciation in a sense, because cap rate is tied to how the market is trading, to get them out as opposed to their ability to operate. We're known for our operations. So a lot of people invest with us because they like the fact that we are so heavily focused on all of the details of asset and construction management. So they're okay with that risk. Alternatively, for individuals who like a more steady cash flow, we have what is called the pref fund. And the pref fund is very interesting because what happened is we would get investors who would call us up and they would say, I have 1 million to invest, and even more than that at times. I only want to invest with you, and this is all the money I have to invest. So I'm just going to hand it over to you because I trust what you guys are doing. And we would spend the next 15 minutes telling them why that was a bad idea. So I didn't say we specialize on raising capital. We specialize on operations. And what we would spend time doing then is we would educate people on why they should be diversified across assets, different type of assets. Even though I just talked about how multifamily historically has had a very strong track record during all market cycles, you never want to put all your eggs in one basket. Just because the history says one thing, it doesn't mean that it'll always be that way. You have to be prepared for any challenge that we could come across. For example, pandemic. Like, who knew that that was going to happen and how the world was going to react? So, you want to make sure that you're across different asset classes, operators. They love us, but what if I get hit by a bus? I'm the one who leads operations. You don't want to be tied just to one single company for operations. And then markets. Markets can change all the time. We see this with different government structures coming in and out. In multifamily, just a little quick tip, the more red a state is, so more Republican a state is, the more landlord friendly it is. The more blue, more tenant friendly. Well, with all this migration going on, what if a state switches? What if it becomes all of a sudden more blue? Then we're going to most likely see more legislation supporting tenants. Well, then do you still want to invest in that state? Are you already invested in that state? So you want to be in different markets with different operators and different asset classes. And when we had these people come to us and say, "Where do you guys invest?" We were like, "Oh, well, we invest in this and this." And then we started saying to ourselves, "Well, we're doing all this work, vetting these different investment opportunities and putting our own capital in, and we're working with these groups. Why not bring our investors who want steady cash flow? It's not as high as the other investment opportunity, but the risk profile is a lot less." And the reason being is we've structured this situation so that our equity that we put into the deal comes after the debt, but before common equity. So basically, if you look at a capital stack, you will see the lender's debt. So that covers, the property on the purchase, typically, anywhere, let's say from 60 to 80% of the purchase price. And then our equity comes in next. So we have a tranche of equity that comes in, and then the common equity, the common investors. So our capital gets paid before the common equity. And on sale, our investors get paid their initial investment plus um, their profits before common equity even gets their initial investment back. So that adds another layer of protection. Now, we're capped at a ceiling, so we don't participate in the upside, but some investors like that. Some investors would rather get a check every month that they can rely on, and nothing's a guarantee. Let me just make sure that that's very clear. But there's more protection, which is why we called it the protected equity fund, um, than if you were to go into just a straight investment as common equity. So that's something we've been very excited about. We have one asset already in that. It's a multifamily. And the second asset will most likely be self storage. So we're lining up something there to hopefully move forward on in the next few weeks. But yeah, those are the two things that we focus and prioritize with Bar Down.
Wow, that is a lot of exciting stuff you mentioned. Now we're getting close to wrapping up now. Is there anything that you want to leave the attendees that are currently in the webinar now and anybody who's watching this recording in the future? Anything you want to leave them off with?
I said at the very beginning of the presentation, if you don't take anything from this presentation, make sure that you focus on identifying a real estate focused CPA. I can't begin to tell you how much of a game changer that was for us personally and every other colleague of mine. So we have a meeting once a year, which is a strategy meeting on how we literally don't pay taxes. So the it's not that we're not paying taxes, it's how do we defer them. And there are really good strategies on how you defer your taxes, and aligning yourself with a strong CPA who specializes in that. There are a lot of people who are like, "Oh yeah, my CPA knows about real estate." And then I say, "Oh, do they also help you with this? They help you with this, they help you with this." Yes, 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 yes. Well, that's more of a general CPA. You want someone who is on the forefront, who knows what legislation is coming down the road that sets you up. So if that legislation gets passed, that doesn't impact you. That's the type of CPA that I'm recommending. Honestly, I don't get anything for this, for sharing who we work with, but we work with Markham, which is a national firm, and we've worked with them for, I think, a little over a decade now. I highly recommend them because they have different departments that are hyper focused on specific areas. So, for example, my husband's Canadian, and we had to, when we first started uh, doing our taxes together when we first got married, we had to figure out, how do we do taxes with, my husband who's not American, and the complexity of his situation at the time. So make sure that you align yourself with someone who helps you, because it can be a game changer. It really really can. It can change you overnight, and you will be surprised at how quickly you can grow your wealth by just changing that one little thing.
Great. Thank you. And John is asking, before we leave off, if you could give the name of your company one more time and your website.
Yes. So the company name is Bar Down Investments, and the website is www.bardowninvestments.com.
All right. Thank you for that. Thank you so much for your time and your patience, Ashley. I want to thank everybody in attendance for their patience and lending your time as well to listen to what Ashley had to present today. If any questions, feel free to reach out to Ashley about what she discussed today in the presentation. If you have any questions about self-direction, always feel free to reach out to Camaplan. You can reach us on our website at www.camaplan.com or email us at info@camaplan.com. So again, I appreciate all of your time and I hope you have a great rest of your day.
Thank you.